Hey everyone, welcome to the KE Report, another daily editorial. This time chatting with Craig Hemke, founder and editor of TF Metals Report. It's been about a month since we last chatted with Craig, and what we always do at the beginning of the year is recap his Macrocast. This is where Craig quickly reviews what happened last year and, more importantly, provides his outlook for 2025. It focused a lot on the precious metals, but then also all the other factors, especially political, geopolitics, and economic factors that play into his forecast for this year. Craig, I want to start off with the title being Inversion Reversion. You're explaining to us what that title means for this year and how it really summarizes your big picture thoughts for 2025. So please, Craig, let's start there. Inversion Reversion.
Well, thanks, guys. I hope you had a great holiday season, and here we are in a new year. Yeah, this is something I started doing about 10 years ago, and I kind of wish I hadn't, because now I have to do it every year, it seems, and it's a laborious process. I'm always glad when it's done. I do it, I found, not for like clicks and stuff. I just do it mainly for me, so that I can look back a year later and see what I got wrong, because invariably, I'm going to get a lot wrong. And if I can look back, maybe I learned something from what happened. And it was valuable last year. I thought the metals would kind of trade sideways, waiting for Powell to start cutting rates. And instead, the metals took off, as we know, in March, and far exceeded. I thought we'd get to 2,300. We got to 2,800. So, it's good to look back and say, okay, well, what was driving that? Could that keep going this year? So that's part of the forecast. But then also, we're right back to, why were we waiting for the Fed to start cutting last year? And I was expecting a faltering economy to finally spark that. You remember, guys, when about this time last year, maybe late December in 2023, the expectations of Fed rate cuts got to be like 6 or 7 being priced in for 2024, but the Fed was saying more like 2 or 3, and we ended up with 100 basis points, or the equivalent of 4. And I figured we had to work that off. There wasn't going to be 7, and I thought that would pressure the precious metals, and it kind of did January and February. And then, like I said, gold took off in March, and silver took off in April. And I figured the same thing is kind of this year, only the opposite. After the jobs report last Friday, now it's like there are some firms like Bank of America saying there's not going to be any cuts this year. And the Fed is still saying 2. I bet they'll be wrong, and that we will have more than 2 by the time we get through the year. It might be a little tough to begin with, just like last year. But once that all kicks in, and why would I expect that? I get in that title of this long answer, Corey. The inversion reversion. I think most folks know what the yield curve is. This, as you move out from short-term to long-term maturities, you're supposed to have a positively sloping line, maybe 2% on the short end, and 4% on the long end. Well, we've spent 780 days with an inverted yield curve, where the short end was higher than the long end. That is universally recognized as a precursor, an ultimate predictor that there will be a recession. What we don't know is, okay, well, when does that recession begins? And if you look at the charts that even the Federal Reserve puts out, the last 6 or 7 inverted yield curves, the recession began once the yield curve uninverted, or reverted back to a normal positively sloping line. This current inversion ended back in about late October, early November. So that tells me, if history is any guide, that the recession is beginning. You'll look back and say, well, yeah, the recession began in the first quarter of 2025, that sort of thing. And if that's the case, if I'm right, if the history repeats, then by the end of this year, we'll be talking about how many times the Fed cut more than they expected. We may even be talking about things like yield curve control by the end of the year. So it's a lot of, you try to look ahead, try to base your forecast, on a lot of things where we're going. And I think where we're going is higher over time in the precious metals.
Well, Craig, there's a lot of people on our show that have brought up the yield curve inverting, and then the uninversion being the signal that usually trips the trigger of a recession. So we'll follow along to see how that looks as the economic picture fills in over the course of this year. But you bring up another good point in your article here, in your Macrocast, about why there was so much strength in an environment where prior to this cutting, there was a lot of rate hiking, and it was really because of the huge amount of central banks buying. But you also point out the global south of the BRICS, just how much gold they bought. And also India has been very active with gold and silver. So it was kind of counterintuitive for people to see gold going up when there was such an aggressive rate hiking cycle. And then when the cut started, people thought there'd be more of a reaction. And gold had a great year last year. But do you think we'll continue to see this strong central bank buying regardless of what happens in the economy?
Well, it seems like it, and that's the big part that I missed last year. Because, like I said, this time last year, I thought, well, gold, I've been capped pretty hard. Was having trouble getting over 2,000 and 2,100 for 3.5 years, and it spiked in early December 23, and then pulled way back. And I thought, this will probably continue for the first 5 or 6 months until it's clear that the Fed's going to start cutting. And of course, gold took off on about the 1st of March. And finally broke out above 2,100 and then was in the 24s by the middle part of April. And then, obviously continued higher. And I think the key to this has been the central bank bid and that constant drain of physical metal, primarily out of London, though, a lot of it going into China as well. And that places kind of like a physical floor under the paper price, because we had the typical rush of speculative money, hedge funds and the like, group them all together as large speculators, whatever. And you get this rush of enthusiasm for futures contracts, and then that kind of runs out of gas. And a lot of times, they get washed back out. It's happening right now as we speak after a rush last week. And then the banks are able to cover a bunch of the shorts that they, put on the way up. And a lot of times that keeps price kind of flat. You get this wash, rinse, repeat. But with that central bank bid, that seems to have precluded the opportunity to wash it back, which is why we were able to go to 2,800, but then only pull back 10% and then rally again right away. Even back, you think back to November, where things were looking a little dicey after the election of Trump, and we had that 10% pullback, and then we immediately bounced back. The official numbers out of China showed that they had stopped buying gold back in May, and it was like, oh boy. Well, now we know the officials numbers out of China, so they resumed buying gold in November, 5 tons, and they bought 10 tons in December. Turkey, India, Russia, Poland, Kazakhstan, you just go down the list. I think that move out of dollars, not entirely, but just a little bit at a time. That move out of dollars into gold has been supporting price now for the last 3 years, and there's no reason to think that it won't continue here in 2025.
So, Craig, just circling back to that main theme here, really, that is a recession coming this year, maybe in the back half of this year. Compare what we've seen in the past throughout history then in terms of market moves and certain signs outside of just that inversion and then reversion of the yield curve. That gives us a heads up that recession is coming, and again, how gold performs immediately when we get these signals.
Well, typically, right, the economy starts to falter and the Fed starts talking about cutting, and then the bond market responds with a bid because they think, well, inflation's going away because the economy is slowing, and so, producers lose that purchasing power that pricing power that they have. And so in general, you get looser financial conditions and you get lower rates and a falling dollar, and, machines buy gold and people buy gold, and that's how that cycle runs. What'll be interesting this time is the amount of accumulated debt now is growing so rapidly and exponentially. As we record this, I think I guess it's maybe it just came out a few minutes ago. I'd have to look. The monthly Treasury statement from the U.S. Department of the Treasury is due out today on the 13th. And they put it out every month. They tell you what the previous month deficit was, or, rare months like April, a surplus. And in just the first 2 months of the new fiscal year, which began on October 1st, so just October and November, the report today will be for December, the U.S. ran a $624 billion deficit in just 2 months. Now, you can't run rate that and take that times 6 because there's going to be some months like April where there's actually a small surplus. But nonetheless, the U.S. is increasingly approaching a rather tenuous financial situation. And you got higher interest rates, with the bond market selling off. That only makes that situation worse. We're already paying $1.1 trillion a year just to simply service the debt. Well, what happens? Again, now we get into an economic decline and a contraction for a couple of quarters or whatever. Well, that's going to make tax receipts fall. And no matter how much Trump and Musk might have ideas about trimming the spending, tax receipts may fall faster than the spending cuts, which means the deficit be even larger. And so then what does the Fed do? And this is where, besides all the basic stuff that we talked about, that you can rely on the past that answers your question, Corey, you look over the horizon. Where could we be by December if that's the case? And I mentioned this earlier. Talking about a way out in left field prediction for 2025, but I wonder if maybe by the December FOMC meeting this year, all of a sudden things like yield curve control aren't discussed openly. We'll see.
Yeah, it could be a brave new world, especially if the deficit keeps growing and if they're cutting taxes, but at the same time, the debts keep piling on and they're collecting less receipts. We could be into a real situation where even the policymakers start paying attention to the runaway debt. Another big theme you bring up in your Macrocast, though, Craig, is the role of the Fed in providing liquidity to other banks. Now, the financial sector has rebounded strongly over the last year. Even when people were pretty concerned, we had all those banking situations and the crisis in the regional banks just over a year ago. But you bring up the point about how big the reverse repurchase agreements have grown on the Fed's balance sheet and their need to provide liquidity to banks and what's happening on the short end of some of the bonds and the overnight. So maybe talk about the reverse repo situation possibly rearing its head again this year.
Well, there was all this cash that the banks were sitting on that was parked at the Fed, sitting in the reverse repo account, call it excess reserves. And the Fed was paying a pretty healthy rate of interest on it to keep it there. It got to be like $2.3, $2.4 trillion at its maximum. Janet Yellen, in her infinite wisdom, decided to get that cash out of there, to get it out into the wild, so it would help promote economic growth. And she issued a couple $1 trillion in T-bills as part of the government debt funding, shifting, from the longer end into the shorter end. Well, that reverse repo account now is down to a couple $100 billion, so it's down by maybe 90% from where it was. Yet the government still has to have that funding requirement. All those T-bills that were issued will be coming due this year and have to be rolled over either into more T-bills or out longer in the curve. Anyway, that's a real liquidity issue that could really start to drag down all markets. So that's something that the Fed's going to have to be watching too. Is there enough cash in the system? Are financial conditions loose enough to keep the stock market afloat? Because what happens? What if it's all of a sudden we get a 15% correction in the S&P? How does that fit into the Fed's plans as well? So there's all these moving parts. And again, that's why I like to write these forecasts, because on any given day, you can turn on financial television and they'll tell you what the narrative is about, where we are right now. But that doesn't really lead you to where we're going to be 11 months from now, with so many different irons in the fire. And that's a bad metaphor for the other thing that probably we should mention, are these fires in California with the losses now. I mean, this is before what might be another terrible 48 hours of fires, but they're thinking $250 billion. I've seen estimates as high as $450 billion. Who pays that? You got there's a California relief fund that doesn't have any money in it. How about the mortgages that now the banks are going to carry, because who's going to pay the mortgage on their house that's a total loss, right? How about the insurance companies that maybe don't have the reserves on hand to pay, and all of a sudden they're looking at their reserves that are in underwater treasuries and mortgage-backed securities and stuff, that you've seen those graphs of the banks that have, $350 billion in unrealized losses that they're just carrying to maturity. Well, what if they got to start selling those because they need the cash to pay pay off mortgage debt and that kind of stuff. So anyway, there are all these different issues out there that on any given day, just are lurking in the background, and we focus on what's driving the markets today. But these are all things that could really get messy as the year goes along, which is why I think this idea that the Fed is not going to cut it all just based off of the last jobs report or the Fed telling us they're only going to do 2. I bet that's proven incorrect.
Yeah, we will see. That is a huge determinant for these markets. How many times will the Fed cut? As of right now, it seems like they're going to be paused for at least a few meetings, but we all know how quickly that can change. Craig, one kind of side question to all this is, what about the new administration? Trump is such a wild card here, and everyone's focused so much on tariffs. What are you discounting? What are you including in some of your forecast here for Trump, his second presidency, and what he could do outside of just the Fed?
Well, the only thing I actually mentioned in the forecast was what I think is this misplaced optimism that came in immediately after Trump got elected, that somehow Musk and Ramaswamy are going to run this committee of government efficiency or whatever, and come up with ideas for how the budget can be cut, and then that's just magically going to happen, and I just think that's just folly. That's not how it works in Washington. One that's an extra constitutional committee. They have no power. Trump has no line item veto. The politicians you see how everybody knows how this works. Politicians, we're going to cut there, but don't cut my programs. Don't cut stuff that affect my constituents. Don't cut stuff that affect my donors. And so from a political standpoint, the only thing I wrote about this year is I think that's a wildly misplaced optimism that somehow Trump is going to really get a handle on this crazy debt burden. Like we just mentioned, I mean, what if the economy collapses? You mentioned tax cuts too, Corey. So what if all of a sudden we're running a $2.5 trillion deficit instead of a $1 trillion, which are still just outrageous numbers? And again, from where will the funding come? I mean, they got to get the dollar somewhere. And if rates are going to 5 or 6% because inflation hasn't gone away and that kind of thing, the Fed's going to be faced with a really hard choice. Powell likes to make himself sound like a man of the people, looking out for the little guy. We got our mandate of 2% inflation, full employment, and all that. He's going to be faced with a choice. He's either going to save the markets and keep the government running, or he's going to let rates go up and crush inflation. Well, you know what? I think we all know what side he's ultimately going to choose. And he's going to justify it by saying, well, keeping the government running and saving the markets benefits everybody, even the little guy, who can't afford eggs. Again, I keep coming back to this. There are so many things lurking this year. Do not be deceived by what, you think in the current day, how this year is going to play out. It's going to be probably significantly different by the time we get to December. And again, that's why I like to write these things.
Craig, I do need to ask you one other factor. You saved it for the end of your Macrocast, but that is the precious metal stocks. What's your outlook? Share some of your overall themes for the underlying equities in this sector.
Well, we've discussed this, haven't we?
Many times, but I want to hear if it's changing for this year.
Yes, my just disdain for Newmont and Barrick the most. And so anyway, I got to the point in writing the Macrocast, I was like, okay, now I got to do the mining shares. I'm like, oh God, do I have to? I think that's almost how I wrote it. In the past, I don't know how many times in a row, I've just like, okay, well, here's a chart of the GDX. Okay, and here's these moving averages and these trend lines. And in the past, if it moves with silver, and that implies a price of whatever. But the GDX last year was only up 8% when gold was up 26. And you're like, well, what the hell is going on here? This is supposed to be leverage to the upside, not leverage to the downside. Well, the problem is 20% of the GDX is Newmont and Barrick. And they're both dogs that can't control their expenses. And now Barrick's got all their problems in where? Mali or wherever the hell that is, that get their mine seized. So I this year I just said, you know what, maybe we'll just have a teaching lesson instead. And rather than, try to project where the shares are going by drawing lines on a chart of the GDX or the GDXJ, I just said, look, do your homework, man. Even Stanley Druckenmiller doesn't do his homework, because all you ever read in his 10Ks or whatever is that, Stanley Druckenmiller bought Newmont. I'm like, seriously? I mean, what? Because he knows the name? I mean, why wouldn't you buy AEM or Alamos or Kinross or some other company that actually controls their expenses so their margins widen as the price goes up rather than the other way around? And so I just kind of, in writing that section this year, I just said, look, man, if first of all, just own the metal, okay? Second, if you want to play around in the sector, try to make some extra fiat, then do your homework, for God's sake. It means coming to you guys' site and all of the people that you interview every single week, every single day, and listen to those people. They understand grams per ton and drill length and all that other crap. And you actually have to put some work into it if you want to make money in the mining shares. You can't just simply buy Newmont or buy the GDX. And so if you're willing to do the work, okay, you can have a pretty good year like AEM had last year. But if you're unwilling to do the work, don't just buy the GDX and then come bitching at me about how the shares are underperforming, okay? And so that was kind of the point of that final section.
But Craig, isn't this a bigger problem for the sector? As much as we hear that we need generalists, new investors to come into the sector, in all fairness, no, these guys kind of dip their toe in buying some of the biggest stocks. And if those stocks aren't performing, then you're not going to get that money that then further trickles down. So as much as it's, I guess, wrong to focus on these big guys, that's just the way the markets and investors work.
You're absolutely right. I mean, it's going to take, I had it in my podcast Friday. What was the drop in the market cap of the S&P on Friday was like $800 billion or something, right? And I'm like, what's the market cap of the GDX is like 13 billion. Okay, so if you really want everything to explode and a rising tide lifting all boats, and we got to get those generalists, we got to get people wanting to be in the sector, and they'll always start by buying those names, and that's kind of how it works. But we can't wait for that. I mean, the people listening to us, the people on my site, we can't wait until maybe that'll happen this year, maybe it'll happen next year, whatever. So as you wait, it just behooves the individual investor. If you want to be in this sector, do your homework. And again, I posted the charts. I mean, what was it? Kinross. Kinross beat the GDX. Kinross was doubled last year, where the GDX was up 8%, something like that. It was terrible. So if you can, again, if you're going to do in the sector, while we wait for, the day where everybody wakes up and gold goes higher and all of a sudden we're like, whoa, there's money to be made in the sector. You can't just sit there blindly and wait. You've got to find some people that can help you. Your side is great. We all know some guys that just absolutely work their tails off writing newsletters and things like that, trying to find the best companies. You got to do some work. You can't just blindly buy the big names in the GDX and keep your fingers crossed. That one day that'll work. That strategy will work, but I'm not sure that's going to be 2025.
Yeah, isn't that the problem though with this sector? And we've seen it many, many times. Is that hey, it just isn't that easy. You do need to do the work. And hey, thanks for calling out our site too, Craig. But look, we just need to understand that's the market that we're in, and you do need to be a stock picker, even as the metals price has gone higher, because just look at how well the gold price has done. But hey, Craig, I will post a link to your Macrocast in the show notes so everyone can read over that. You all enjoy Craig's Macrocast. Share your thoughts with us, and we'll chat with Craig hopefully next week. Craig, great having you back in the new year. I hope you had a very happy new year.
Thanks, boys. Have a great week.